Hey everybody, Adam Colombo here with the Miraz Group, and today we wanted to share with you a little bit of information that we've been reading a lot about, and we wanted to kind of clear the air. And that has to do with this idea of an impending recession and what that means for your home value. Okay? If we start to think about the idea of recession equaling lower home prices, I think there's a little bit of a danger there in that we're not doing a service to you all, right? Now, it is totally understandable that recession might equal lower home prices in a lot of people's mind because the Great Recession is still such a vivid memory for a lot of us. The Great Recession, which began in 2009, was terrible in a lot of ways, whether it be almost 10% unemployment or home values dropping around the country by an average of 19%. In Phoenix, it was actually a little bit closer to 50% in some areas. And all of that happened. That was very real. But that recession in particular was centered in our housing market. So if we go back and take a little bit of a historical look at the Great Recession, we can pull apart some of the reasons why that happened and look to see whether those things are currently in the market. So if we go back to before 2008, 2009, there was a lot of policy that was written and a lot of sentiment that we wanted everybody to be a homeowner. And for good reason. Home ownership is the number one way to build your family's wealth. The issue was in practice how we actually went about trying to accomplish that. Early in the 2000s and in the mid 2000s, you saw a lot of mortgages being written for people that had low credit scores or were classified as subprime borrowers. There were a lot of people that bought homes that had a very inconsistent employment history. There were a lot of people that purchased homes with 0% down, meaning they borrowed the entire 100% from their bank, which kind of allows them to have no skin in the game when it came to paying their mortgage. We look at that, we call that moral hazard, right? There was a little moral hazard there because people were okay walking away from their home, all right? Now, all of those things added to the massive bubble that was surrounding home values, okay? And home prices are just a simple supply and demand equation. So as all of those lending practices were occurring in the early 2000s, it grew the number of buyers in the market substantially. And so there were way more people in the market looking for homes than there were homes to buy. Yes, home builders were building them as fast as they could to try to meet the demand, but it just wasn't enough. And you saw the home prices just skyrocket and then subsequently collapse on the back end. Now, we've been in an economic expansion for about 10 years since that recession began. And we are going to have a recession or a recessionary period at some point, okay? And the definition of recession from an economic perspective is where the GDP of the United States falls for 2 consecutive quarters. GDP being the gross domestic product, which is the measure of all the goods and services in the United States that are bought and sold. When that falls for 2 consecutive quarters or 6 months, then we are in a quote unquote recession. Over the last 4 decades, we've had 5 formal recessions in the United States. In only 2 of those have housing prices fallen. Obviously, 2009. The second one was in 1991, and home prices fell less than 2%. The other 3 formal recessions, 1980, 1981, and 2001, actually saw home values increase by an average of 5.3%. Okay? Think about that. 3 out of the last 5 recessionary periods, home prices actually increased by 5.3%. Okay? That means your wealth was still growing while the economy was in a recession. Okay. So today, Bloomberg News came out with a measure where they believe we have about a 27% chance of entering a recession in the next 12 months. Okay. What might be some of the reasons for that? Well, according to a real estate think tank called Keeping Current Matters, they do research on the real estate market nationwide. There are they listed the top 10 triggers that might happen for the next recession, with number 1 being the most likely event to trigger a recession, and number 10 being the least likely. Okay. Number 1, trade war. And there's no doubt about it, the fact that there are competing views on trade policy around the globe. And that causes a lot of uncertainty in terms of what consumer goods are going to cost, what the cost for construction equipment is going to be. All of these things play into our economy. So number 1 reason we may have a recession, okay, is trade policy. Number 2 is going to be the stock market value. Right now, the stock market is not actually a measure of whether we're in a recession or not. The stock market is literally just a measure of people's expectations of what something is going to be worth in the future. Now, if those expectations change, then you might see the stock market react. Right? The third reason, geopolitical events. As with any time period, really, if there's a chance for governments to disagree, for conflicts to break out, it's going to have an economic impact in those areas, right? Number 4 is monetary policy. And we've heard a lot about this lately as well. Monetary policy is the Federal Reserve in the United States setting interest rates, increasing interest rates, lowering interest rates. They've been in a process of lowering rates lately. And some uncertainty around inflation. And what we've typically learned about inflation has been kind of absent. So there's some risk there in terms of monetary policy. Number 5 is downgrading of corporate debt. Corporations borrow a lot of money when they grow, and they owe that money back to their investors. If for some reason there was a kind of feeling that these corporations weren't able to pay back some of their debts, either their profits are falling, their revenues are falling, that could trigger a recession. Number 6 is fiscal policy, right? So this is where we're talking about the actual congressional policy of the United States surrounding how we spend our money, right? Now, this could go for any government, but fiscal policy really surrounds these days how much debt a government runs up. And governments around the world are spending more money than they ever have and running debt ceilings higher than any historical number we have. And so if there was ever a reason that a government may not be able to pay its debt, you're going to see some recessionary outcomes. Okay? The next is just pure political gridlock. And we've experienced that here in the United States, where Washington, D.C. is just so divided on particular issues, we may not be able to meet the kind of policy needs of the country. And we may get some recessionary values coming out of that, or some economic slowdown. There are always other economic factors sitting at number 8, right? Whether it be environmental factors, whether it be oil prices, right? All of these things kind of play a role in certain sectors and could promote a recessionary period. At number 9 on the list, we finally get to the housing market and a possible housing slowdown. So the only thing that Keeping Current Matters believes would be less likely to cause a recession than housing prices or housing slowdown is city or state debt. That's number 10 on the list, right? So the ability for cities or states to pay their debt. Okay, so number 9 was housing slowdown. So out of all of those things, there are 8 reasons that are more likely to trigger a recession than the housing market. Okay? Now, I totally understand that when you buy a home, you want the value to go up. And people always look to buy a home and have that price increase 2%, 3%, 5% a year is what we've been seeing in some parts of the valley. But buying a home is, and always should be, a long-term investment. And if we look at those housing prices historically in the valley, the greater Phoenix area, home values have gone up almost 82% since the year 2000. So if you were a homeowner that made it through the recession and still own your home, you've still seen an incredible growth in the value of your home over the last 19 years. Okay? So with that in mind, we really just want to circle back to summarize that if we were to have an impending recession, that does not mean that your home's value is going to fall. If you're in the market for purchasing a home and you want to try to maybe time the market and say, if we have a recession, I'm going to wait to buy a home until that recession hits and we're going to have some lower home prices. That very well may not be the case. It is still the case today that home prices are increasing, mortgage rates are low, and the environment is very healthy surrounding our housing prices. Okay? So if you have any clarifying questions about whether it's the right time to buy, whether it's the right time to sell, maybe you are questioning what the finances are surrounding a home decision, please reach out to us. We're happy to clarify. We're happy to share information. And I hope that you found this informative.